Welcome back to Investing Talk Podcast.
Today, we're looking at CAVA Group.
As usual, before we start, subscribe, like, and comment to this video to support the show.
So let's just set the stage here. It is February 2026, and CAVA has just dropped their Q4 numbers for fiscal year 2025. And, the headline numbers are grabbing a whole lot of attention right now.
Yeah, they really are.
Right, because revenue is up over 20%. They are completely profitable. And perhaps most surprisingly for a growth company in this particular sector, they are sitting on zero debt. So the big question everyone is asking is pretty simple. Is this the next Chipotle?
Okay, hold on. Before we crown them the king of bulls, I really have to play the skeptic here.
Fair enough.
Yes, I see the revenue jump. I see the headlines just like everyone else, but let's look at the chart before this earnings drop.
Yeah.
The stock had been down 35% over the last 12 months.
It was a rough year, yeah.
That is a significant slide for any company. So when I see a sudden epoch, I have to ask you, does this valuation actually make sense based on the fundamentals? Or is this just another cycle of hype around hummus and bowls?
That is exactly the tension we need to resolve today. Is this a dead cat bounce, or is the business actually turning a corner? To figure that out for you guys listening, we have to look past the flashy headlines and really dive into the raw numbers from this Q4 report.
Right. Let's look at the trajectory then. What are we actually seeing in the earnings print?
Well, the growth story is definitely intact, and it's accelerating in some really key areas. For the fourth quarter of fiscal year 2025, CAVA reported revenue of $274.99 million.
Wow.
Yeah, that represents a 20.9% increase year over year compared to the $227.4 million they pulled in during the same quarter last year.
And just to add some context to that for you, because, percentages can be abstracts. They didn't just grow. They actually beat the street.
They did.
That number beat consensus estimates by about 2.54%. And that brings us to that massive milestone you hinted at. For the full year, they have officially cleared over $1 billion in revenue. That puts them in a totally different weight class.
It absolutely does. Crossing that billion-dollar mark is often where institutional investors, they sort of stop looking at you as a speculative bet and start looking at you as a real category leader.
Definitely.
But look, revenue is vanity if you aren't keeping any of it, right?
Yeah.
What's crucial here is the profitability. Their adjusted EBITDA came in at $152.8 million. And if we look at GAAP net income, they posted $63.7 million.
Which is solid.
Exactly. This isn't a company just burning cash to grow anymore. They are generating real, tangible income.
Okay, but I want to drill down into the earnings per share, the EPS, because this is where things get a little sticky for me. And I feel like the headlines are just glossing over it completely.
Okay, let's unpack it.
So Q4 EPS came in at 4 cents. Now, on one hand, the bulls are going to say, hey, that beat the estimates of 3 cents by over 55%.
Which sounds great on paper.
Right, it sounds great. But if you look at the previous year, EPS was 5 cents. So we actually saw a year-over-year decline in earnings per share, despite that massive top-line revenue growth.
Yeah.
So my question is, why didn't that efficiency scale perfectly to the bottom line here? If they are selling so much more food, why did the profit per share actually drop?
It's a really great catch, and it's honestly the nuance that separates the retail traders from the serious investors. The dip in EPS is largely due to how heavily they are reinvesting back into the business to fuel that expansion.
Okay.
They're basically spending money to make money right now. But before we leave the financials, we really have to look at where they are going. Management provided guidance for fiscal year 2026, and they are projecting same restaurant sales growth of 3 to 5%.
And here is where it gets really interesting for me. How exactly are they getting that growth? Because they implemented a 1.4% menu price increase in January. So a chunk of that supposed growth is just charging a customer more money. It's not necessarily all coming from more foot traffic. Is that sustainable for them?
That is a fair point. I mean, pricing is always part of the equation, and you can't ignore the broader inflation trends. But they aren't just raising prices and hoping for the best.
What else are they doing?
They are banking heavily on product innovation to drive actual traffic. They've introduced some new items, specifically a new pomegranate glazed salmon.
Salmon at a fast casual place.
Exactly. And it's actually a brilliant strategic move if you think about it. Think about the veto vote.
The veto vote.
Yeah, when a group of coworkers or a family is deciding where to eat, usually the healthiest eater in the group vetoes the burger joint or the taco spot. By offering a high-quality protein like salmon, which is something you usually have to go to a sit-down restaurant to get, CAV wins that veto vote.
Oh, that makes sense.
Right. They believe this specific item is going to be a significant driver for that 2026 growth. It's all about offering something premium that you can't easily get at a drive-through window.
Well, salmon at drive-through speed is definitely a differentiator, I'll give you that. But let's talk about the safety net. You mentioned zero debt earlier.
Yes.
In this specific interest rate environment where borrowing money is just incredibly expensive, that really stands out to me.
It is the golden ticket for CIVA right now. They ended fiscal year 2025 with $393 million in cash and, as we said, zero debt.
That is incredibly rare for a high-growth restaurant chain. Usually you see these companies just loaded up with leverage to fund new locations they borrow to build.
Constantly.
But CIVA is sitting on a cash pile that basically gives them a fortress balance sheet. If the economy turns or if consumer spending drops off a cliff, they aren't answering to creditors. They don't have these massive interest payments eating up their cash flow.
Exactly. They control their own destiny right now. And because they aren't servicing debt, they can pour that free cash flow directly into expansion.
Which they are doing.
Very aggressively. In 2025, they opened 72 net new restaurants, which brings their total to 439. And the plan for 2026 is even bigger. They are targeting 74 to 76 new openings.
So if we calculate that trajectory, they are steadily marching toward that long-term target of 1,000 units. And it's important to note for you listening, they aren't doing share buybacks to artificially pump the stock, and they aren't paying a dividend. Every spare dollar is going right into building more restaurants.
Which is the exact right move for a company at this growth stage. But it's not just about slapping up more stores. It's about the unit economics, the profitability of each individual restaurant.
Right.
This is what we call the operational moat. New unit productivity is currently over 100%. The class of restaurants they opened in 2025 is generating average unit volumes, or AUVs, above $3 million.
That $3 million number is the benchmark in this industry. That puts them in truly elite territory. I think Chipotle is one of the very few others in that stratosphere.
Pretty much.
But what actually protects them? Why can't a Sweet Green or revived Chipotle just crush them? Or even just a local Greek spot on the corner?
Well, their argument is that the Mediterranean category offers a really unique blend of health and flavor, what CAVA calls heart, health, and humanity.
Kitschy.
Very. But it creates high switching costs for loyal customers. It fits the current health trends perfectly without tasting like boring diet food. Plus, they are heavily investing in logistics. It's not just food, it's engineering.
Right. They are rolling out those kitchen display systems, the KDS, in 370 restaurants. And they are putting TurboChef ovens company-wide.
Exactly.
Sounds boring to talk about ovens, but that's speed, that's throughput. When you have a line out the door, the bottleneck is almost always the kitchen.
Always.
KDS and TurboChefs mean they can get that salmon cooked and that bowl assembled way faster. That's how you get a lunch line moving fast enough to actually hit that $3 million AUV.
Precisely. It's operational excellence backing up the brand promise.
Yeah.
If the line moves too slow, people just stop coming no matter how good the hummus is.
Okay, so the kitchen is working, and the bank account is full. Let's pivot to the charts to see how the market reacted to all this. Because numbers on a balance sheet are one thing, but price action tells us what investors are actually doing with their capital.
The immediate reaction to the earnings print was undeniable. The stock surged 9% right out of the gate.
So we have to contextualize that for the broader market. Year to date, CAVA is now up 16.5%.
That's huge.
Compare that to the S&P 500, which has been relatively flat over the exact same period. This is a clear case of investors rewarding a beat and raise scenario. They beat the estimates and they raise the outlook. Wall Street always loves a raise.
They certainly do. And from a technical structure standpoint, it looks very constructive right now. We are seeing a potential bullish signal forming.
Let's hear the numbers.
The 50-day moving average is currently sitting at $64.66, and it has just crossed above the 200-day moving average, which is at $61.52.
That's Golden Cross territory. For the technical traders out there, that is often the ultimate green light.
It is.
It signals that the average price over the last 2 months is now higher than the average price over the last year. It implies the momentum is fully shifting back to the upside. And it's significant because, as I mentioned in the intro, the stock had been bleeding for a year.
Right.
A 35% decline is painful to hold through. This cross suggests the bleeding might finally be over.
And the trading volume completely supports that view. We saw headlines everywhere about the stock soaring, and that brought in highly elevated trading volume on the breakout.
So it wasn't a fake out.
No, it wasn't a quiet move up on low volume. There was real participation. Big money was clearly buying in.
I'm still a little cautious, though. I
Yeah.
want to see if this trend actually holds. We've all seen dead cat bounces before where a stock drops 35%, pops for a day because of short covering, and then just rolls right over again.
Sure.
But I have to admit, those moving averages crossing is a very strong argument for a real trend change.
It certainly suggests the momentum has permanently shifted. Now, if we look beyond the charts to the market perception, let's talk about what the smart money is doing.
Yeah, let's check the vibe there. What are the analysts saying now that these numbers are officially out?
The mood is overwhelmingly bullish. Following the earnings, Truist actually raised their price target to $80.
So the street really likes the revenue beat, coming in at $275 million against that $272 million expected range. And they seem to really believe in that 2026 outlook.
They do.
But I have to take us back to the skeptics' corner for a second regarding insider activity.
Okay, what did you find?
Because while Truist is out there saying buy, someone else on the inside was actually selling. I found a specific data point that bothers me slightly. CEO Brett Schulman sold 4,542 shares on January 27, 2026, right before this massive earnings drop.
I see where you're going with that, but I have to push back a bit on the context.
Go.
In the grand scheme of things, 4,500 shares is a relatively tiny sale for a CEO of a billion-dollar company. It's highly likely that was for tax purposes or just standard portfolio diversification. Executives get paid primarily in stocks, so they have to sell some to buy houses or pay taxes.
True.
Given the company has zero debt and a massive growth plan, I wouldn't read that as a jump ship signal at all.
Fair enough. It's not a massive dump or he's liquidating his entire position. But still, as an investor, you always prefer to see insider buying, especially when the stock had been down the previous year.
That's a fair point.
If the stock was so incredibly cheap at down 35%, why wasn't the CEO buying more? Seeing him sell even a little bit just makes me pause.
That is a very healthy skepticism to maintain. However, if we look at the broader news context, the sentiment analysis of the top financial stories is heavily bullish. The narrative right now is hyper-focused on that $1 billion revenue milestone and CAVA's position as a category-defining company.
And notably, there are no speculative rumors floating around, no buyout talks, no merger whispers. This is purely an execution story. It's literally just, can they build the restaurants and sell the food?
Exactly. But execution is never absolutely guaranteed, and frankly, there are some real clouds on the horizon that we haven't touched on yet.
Hold on. We need to look at the risks before we get too excited here.
Yeah.
We've talked about all the good stuff, the cash, the salmon, the charts. But what can go wrong? Because in this market, something always goes wrong.
There are definitely hurdles. One of the biggest is margin compression.
Okay.
We talked about that pomegranate glazed salmon earlier. It's a great product. It drives foot traffic. But new menu items like that are hitting restaurant margins by approximately 100 basis points.
Let's break that down for the listener quickly. 100 basis points equals 1%. That might sound incredibly small to someone outside the industry, but in the restaurant game, where margins are razor thin, losing 1% of your profit margin just to get a product on the menu is super expensive.
It really is.
That's the core trade-off. You get the fancy item to drive the sales, but it costs you more to actually make it.
Exactly. It's a calculated risk to drive retention, but there is a much bigger financial headwind that I think listeners need to really understand. The tax bill.
Oh, man. This is the one that nobody ever talks about until it ruins a quarterly report.
Precisely. This is a massive factor for 2026. CAVA has been benefiting from a very low tax rate, roughly 10%, likely due to past losses or specific tax assets they were using up as they grew.
Right.
But that is changing now. The tax rate is rising to a range of 25 to 30%.
That is a massive jump. You are effectively tripling the company's tax bill overnight. That is going to weigh incredibly heavily on reported EPS growth going forward.
It will.
Even if top-line revenue just soars, the bottom line is going to look squeezed because Uncle Sam is stepping in and taking a much bigger cut.
That perfectly explains why the EPS growth might not look nearly as explosive as the revenue growth this coming year. Investors really need to be prepared for that visual disconnect. And when you combine that tax rate with stock-based compensation, which is running around $22 to $24 million, you have some very real pressure on the earnings per share.
I also want to circle back to the traffic versus price issue we touched on. They are guiding for 3 to 5% same-store sales growth, right?
Yes.
We know 1.4% of that is purely price increases.
Yep.
My worry is the consumer. We are seeing pushback across the entire fast food industry on pricing right now.
We are.
If CAVA keeps raising prices to protect their margins from that salmon, do people eventually stop coming? Is a $16 bowl of fast casual salmon sustainable for the average lunchgoer?
It is a totally valid concern. However, the counter-argument is the demographic. CAVA targets a slightly more affluent consumer base who is willing to pay a premium for that heart, health, and humanity ethos.
It's true, it's a different crowd.
They aren't competing for the dollar menu customer at all. The fact that their AUVs are over $3 million suggests the demand is clearly there, even at these elevated price points.
But the algorithms are worried about it. We have to mention the rank. Zax has them at a number 4 sell rank right now.
That's right.
That is highly likely because the valuation looks incredibly rich relative to that rising tax rate and the margin pressure we just discussed. The computers look at the PE ratio, they look at the tax headwinds, and they just say, too expensive.
The valuation is certainly pricing in a lot of perfection. When you trade at these kinds of multiples, you simply cannot miss an earnings estimate.
So what does this all mean for the listener? We've looked at the billion-dollar milestone, the zero debt, the charts, and obviously the tax edicts. Let's bring it to a verdict. If I'm holding this stock or thinking about buying, where do we land?
Based on the analysis, I am assigning CAVA a bullish score of 8 out of 10.
An 8 out of 10. That is pretty high given the tax issues we just went over. Walk us through the elevator pitch for that score.
It all comes down to the fundamentals at the end of the day. CAVA has successfully crossed the $1 billion revenue threshold. They are sitting on $393 million in cash with zero debt.
A huge deal.
In this economic environment, that is the ultimate safety net. It allows them to control their own destiny completely. They are opening 74+ units in 2026, fully funded by their own cash flow.
But there is a caveat, right? Because this isn't a get-rich-quick trade.
There is a caveat. This is a multi-year hold. You cannot expect a straight line up on the chart. You have to be willing to weather the tax rate adjustment this year and the margin pressure from those new menu items.
Right.
The whole thesis is about getting to that 1,000 unit scale over the next few years. You are betting on the long-term footprint, not next quarter's tax bill.
It really is a long game. You're essentially betting that they can replicate that $3 million unit volume across hundreds of brand new locations all over the country.
Exactly. That AUV metric is their true moat. As long as that stays above $3 million, the underlying business model works beautifully. The post-earnings surge suggests the market is finally re-rating the stock toward that truest $80 target, realizing that the growth story is far from over.
Before we wrap up, I just want to leave you with a thought. Think about what happens when they hit unit 800 or 900. Can that heart, health, and humanity ethos really maintain its premium appeal when the brand is everywhere and the novelty wears off? It's a compelling case today, but you have to keep an eye on how well they scale that culture. And as always, I have to remind you to do your own research. Those tax headwinds are very real, and the consumer is fickle. Don't just take our word for it.
That's the breakdown on CAVA.
Subscribe, like, and comment to this video to support the show. We'll see you in the next one.